What if the housing market is not waiting for lower rates, but waiting for lower prices? Right now, we are observing one of the weakest demand environments in modern housing history. Mortgage applications remain deeply below pre-pandemic levels. Google searches for homes for sale have fallen to historic lows. Pending sales and transaction volumes continue to operate far beneath prior cycle averages. Mechanisms matter here. When buyer inquiry collapses, when application volume compresses, when transaction velocity slows, that is not a narrative problem. That is a liquidity problem. Within our strategy framework, we separate price from pressure. Price is the headline. Pressure is what drives the next phase. Demand pressure is clearly contracting. At the same time, inventory is gradually rebuilding from the extreme pandemic lows. Builders have already responded pragmatically, cutting effective prices through incentives, rate buydowns, and concessions. Existing sellers, however, remain anchored to prior peak valuations. That gap between clearing price and asking price is the current friction point in the system. When we analyze phase sequencing, we see three layers. Phase 1 was the demand shock driven by affordability compression. Phase 2 is the inventory normalization now underway. Phase 3, which carries increasing probability into the coming quarters, is broader price reconciliation. We are not forecasting certainty. We are assigning probabilities. If demand remains structurally weak and rental markets continue softening, the likelihood of incremental price declines increases meaningfully across previously resilient regions. An important secondary mechanism is rent deflation. In several Sunbelt metros, new lease rents have declined year over year. Concessions have expanded. Vacancy rates are elevated. Housing is a yield asset at the margin. When rental income softens, investor bid discipline tightens. That transmits pressure back into resale valuations. Signals over outcomes. The signal here is aggregate housing demand, both owner and renter, is decelerating. Mid-cycle adjustments can take time. Equity cushions remain historically large, which reduces systemic financial instability risk relative to prior downturns. That matters. But liquidity cycles can still produce localized drawdowns of 15 to 25% in markets that overshot income fundamentals. Austin provides a case study. Values have corrected sharply, while incomes continue to rise, compressing overvaluation metrics toward historical norms. That is what normalization looks like. If you find this type of phase-based analysis useful, consider subscribing. We focus on identifying structural shifts early so you can understand what probabilities are expanding and which ones are contracting across the macro landscape. It is also important to state clearly that this discussion is educational in nature and not investment advice. We are mapping mechanisms and probabilities, not providing individualized recommendations. Looking forward, we assign elevated probability to continued inventory drift higher into the seasonal spring and summer window. If inventory exceeds prior seasonal peaks, while demand metrics remain suppressed, price elasticity likely increases. Conversely, a sustained reacceleration in buyer applications and inquiry would serve as an invalidation signal. That is what we watch: confirmations versus invalidations. Policy proposals may generate headlines, but historically, housing cycles resolve through price and income realignment, not rhetoric. Optionality improves when valuations normalize. Conviction increases when signals align across demand, supply, and credit conditions. Until then, the environment remains transitional. We do not frame this as collapse or recovery. We frame it as a probability distribution shifting phase by phase. In the current sequence, mechanisms suggest further reconciliation ahead before durable expansion resumes.